Hello and welcome back to another session, Types of Mortgages. There are many types of mortgages in the market. These are designed to suit various requirements of the borrowers, including the length of the mortgage, capability for the initial payment, and the other financial obligations. The products can be broadly classified based on the features, like there are types of the mortgages which are based on the guarantee, who is giving the guarantee and what level of guarantee is given by those corporations, what are the different type of interest rates on a loan product, and what are the different special types of mortgages. Let's learn quickly about what are the different type of mortgages based on the guarantee. First one is government loans and the conventional loans. In the conventional loans, you would see non-conforming and conforming. In the government loans, you would see Veteran Affairs, Federal Housing Administration, Rural Housing Services. Again, in non-conforming conventional loans, you have jumbo loans, you have subprime loans, and you have alternative A loans. All right, let's learn about the government loans. These are the loans either guaranteed or insured by the Federal Housing Administration, which is FHA, which is part of the US Department of Housing and Urban Development. The Veteran Administration, VA, and the Rural Housing Services, RHS, which is a branch of the US Department of Agriculture. These agencies do not typically originate the loans, except for the low income and other specific borrowers directly, but guarantee or insure the loans originated by others provided they meet their underwriting norms. The financial requirements for FHA loans, which is this Federal Housing Administration loans, are relaxed and compared to the traditional commercial loans. So an individual with an adverse credit limit and who is not eligible for a prime mortgage could be eligible for a FHA loan. Also, the interest rates charged on an FHA loan are lower than those of the conventional loans. Then VA loans, that is Veteran Affairs loans, are designed for qualified veterans and offer more relaxed standards for the qualification than either FHA loans or the traditional loans. For example, in 2002, the loans can be for amounts up to $240,000 and requires no down payments. RHS, Rural Housing Services. They offers both guaranteed loans through approved lenders and direct loans that are government funded. These are offered to low income families living in the rural areas or small towns for the purchase, construction, or repairing homes. All right, let's learn about the conforming and non-conforming loans, which are conventional loans. Conforming loans, these loans with the loan size limitations, amortization periods, and the underwriting guidelines set by the Freddie Mac and Fannie Mae in the secondary market. Conforming loans may be sold to the Freddie Mac or Fannie Mae, which are government-sponsored entities, basically, which in turn securitize, package, and sell these loans to investors in the secondary market. We're going to learn about what is this loan securitization, packaging of the loan portfolios and all in the later sessions. So what is non-conforming loans? So these loans are not eligible for purchase by the government sponsored entities like Freddie Mac and Fannie Mae, but can be sold in the secondary market as whole loans or can be pooled, securitized, and sold as a private label mortgage-backed securities. Non-conforming loans comprise of jumbo loans, subprime loans, and the Alt-A loans. What is Alt-A loans? Alt-A mortgage loan is provided to the borrowers who have good job stability, good income, but their credit scores don't fit the A credit guidelines. This could either be due to a short credit history or due to a slight derogatory hit on the credit score, such as a 30-day late payment. In that case, you might be wondering what are the target market for Alt-A? So basically, they are the strong credit quality with a non-standard needs. For example, limited documentation. So you don't have to do much documentation in Alt-A loans. And the people with a self-employment and which are who wants to process the loan on a quickly basis. That means like need for process efficiency. These are the different target market for the Alt-A loans. And what are the different typical guidelines? Your credit score or the FICO score should be like 680 plus. So higher the FICO required for the increased LTV levels, and maximum LTV like loan to value ratio should be like 75% to 90% range. Over 80% requires private mortgage insurance. Credit history: no mortgage late payments, no notice of default, no foreclosures in the first 36 months. Overall excellent credit history. Maximum debt ratio, I will talk about that again. So it should be like 38% to 45% range. Documentation: the documentation should be enough for like providing what is the stated income, and there is no ratio. Strong compensating factors for the non-standard features, like if you are any one of the standard feature is lacks in terms of approving the loan, then they can look for any other compensating factors. So sample pool profile would look like there would be a FICO of 730 for FICO, Fair Isaac company credit score, which is 730 as an example, and your loan to value ratio is 70%. And what are the different document types you would be required for the Alt-A is like stated income is like 70%, no ratio is 15%, and NINA is again 10%. I'm going to explain all of these things in the later session again. And full doc is only 5%, owner occupied is 90%, and purchase in the rate term free finance is 75%. So these are some of the examples where someone who wants to go for an Alt-A loan would be having different characteristics. All right, so what are the subprime loans? Subprime loans are loans given to the borrowers with a poor credit history whose credit characteristics do not meet the requirements of the Fannie Mae and the Freddie Mac. These loans typically have higher down payment and higher interest rate. These are really the risky loans. The bank has to take a lot of risk in terms of providing the subprime subprime loans. Target market: so borrowers with a blemished credit history who do not have a good credit score, which should be like your credit score, if it is less than 680 or 630, they all belong to subprime market. What are the typical guidelines in subprime? Credit quality ranges from B to D as defined by the lender. It's again defined by the lender. FICO down to 500 or below, so it can be less than 500 also, your credit score. And FICO drives the credit grade. FICO actually, they are the one who analyze the credit score. Credit history allows for the major derogatory credit. Numerous mortgages and major credit late means there are so many late payments in their history of the payment. Some credit grades may allow recent bankruptcy, notice of default, and foreclosures. So the borrower might have gone through bankruptcy or foreclosures in the history of the payment. And the debt ratio can be higher, but it cannot go beyond 55%. Maximum LTV is basically depending on the what credit grade the borrower is really looking for or is really having. And documentation, whether it's a full documentation, I mean, as actually in order to safeguard himself, right, the lender, he would do the full documentation for the subprime borrower. So sample pool profile would look like the FICO is 600, LTV is 80%, and document types are like full or alternative documents 75%, stated income 25%, and owner occupied is 95%. So owner has to occupy that particular residence or a home. All right, so let's learn about jumbo loans. What are the jumbo loans? Jumbo loans are the loans in which the loan amount is above the limit set by the Freddie Mac and the Fannie Mae. This limit changes annually based on the single-family home price survey done by the Federal Housing Finance Board. For example, in 2002, a conforming loan limit was $300,000 and $700. So loans that are above that limit are called as the jumbo loans. Jumbo loans have the interest rates higher by about 0.25% to 0.50% than the conventional loans. All right, so we learned about what are the different type of mortgages based on the guarantee given by the government sponsored enterprises like Freddie Mac and Fannie Mae. All right, let's learn about what all the different type of mortgages are there based on the interest rate. So the first one is fixed rate mortgage. This kind of mortgage comes with an interest rate that will never change over the entire life of the loan, irrespective of changes in the market rates and the economic trends. However, there could be a change in the property tax and any insurance payments included in the monthly payment. The term of the fixed rate mortgage is usually 15, 20 or 30 years. So this is how a fixed rate mortgage would look like. I just given an example fixed 40 due in 30. So this is one of the fixed rate mortgage as an example. Next one is adjustable rate mortgage or ARM. An adjustable rate mortgage has an interest rate that changes based on changing the market rates and the economic trends. ARMs usually have an initial period of time during which the rate won't change. For example, the interest rates for the ARMs can be tied to 1 year US Treasury bills, rates on the certificates of deposits, the London Interbank Offer Rate, LIBOR, or COPI, or other indexes. So I will talk about all these things in the later sessions. Let's learn about how these adjustable rate mortgages just work for now. And the third thing is the hybrid loans. Hybrid loans combine the features of a fixed rate mortgage, that is FRM, and an adjustable rate mortgage, that is ARM. The hybrid loans interest rate and monthly payments are fixed over a specified period of time, beyond which the loan will convert into and stay as an ARM for the remainder of the term. The initial rate may be fixed for 3 to 5 or 7 or even 10 years, beyond which the ARM takes over. The ARM adjusts every 6 to 12 months. The longer the initial rate stays fixed, the higher will be the rate, but the initial rate of a hybrid loan is usually lower than that of a 30-year FRM. The initial interest rate will be higher than an ARM since the rate remains fixed for much longer than that of a normal ARM. A normal adjustable rate mortgage would offer a fixed rate for say 6 to 12 months. So that's all about hybrid loans. What are the balloon mortgages? A balloon mortgages offers an initial fixed interest rate for the 5 to 7 years and then requires a balloon payment. Basically, so they would provide you the less interest rate in initial 5 or 10 years, and later the banks would expect a huge payment from the borrower. The balloon payment is the final payments of the loan and pays off the entire balance. Basically, so if you have any plan after 10 years your income is going to become tenfold or 15-fold, if you're sure about those kind of things, then you can have this balloon loan where you would pay the less interest in the beginning and you would pay off the entire the loan amount later at one shot. What are the graduated payment mortgages? So a graduated payment mortgage would have a fixed interest rate with a monthly payments that gradually increase by predetermined amounts during the early years of the loan, and then level of say after 5 years. A GPM would be useful for the borrowers who expect their incomes to increase significantly over a period of time, or a gradual period of time. So if borrower thinks so his income is going to increase, then graduated payment mortgages loans are the best bet for those kind of borrowers. However, GPMs carry the risk of having the loan principal to actually increase during the early years when the payments are low and inadequate to meet the entire interest payment. So a graduated payment mortgage is designed to start with the homeowner owning minimum payments. Then over time, the payment amount increases. A low initial interest rate is used to qualify the buyer. This lower rate allows many who might not otherwise qualify for a home mortgage to be eligible because they can afford the low initial payments. Had the note been written at a higher interest rate, these buyers may not have qualified due to the higher monthly payments. This type of mortgage payment system may be optimal for the young or first-time homeowners as their income levels tend to rise gradually. Alright, this is all about different type of mortgages based on the interest rate. Alright, so there are different type of mortgages based on the special type. Alright, let's learn about what are those different special types. First one is bridge loans. So borrowers who plan to take a new home before selling their current one can go in for a bridge loan to span the gap between the two transactions. So bridge loans can either be structured to completely pay off the old home's mortgage or to add the financial obligation of the new home to the existing mortgage. Typically, the loan is structured with a short term, often 1 year, and hefty prepaid interest, perhaps 6 months worth of interest. Okay. Most often, a bridge loan is used to pay off the existing mortgage with a remainder minus closing cost and the prepaid interest, going toward the down payment of the new home. If after 6 months the old home has not sold, the borrower begins making the interest only payments on that loan. When the home sells, the bridge loan is paid off. So if it sells within the first 6 months, any unearned interest payments will be credited to the borrower. Alright, what is piggyback loan or 80 by 10 by 10? So when the mortgage amount is more than 80% of the purchase price of the home, lenders require the borrowers to take the insurance on the extra amount. It is called PMI, private mortgage insurance, and the borrower pays for the premium. The cost varies, but it can be equivalent of an additional half to 1% of the loan amount per year. Furthermore, this cost is no tax deductible. With the 80-10-10 financing, the borrowers make a cash down payment of 10% of the purchase price. They take out the two mortgages, a new first mortgage for the 80% of the price and 10% of the second mortgage. Often, the first and the second mortgages are from the same lender. The interest rate on the second mortgage will be about 2% higher than the going rate on the first mortgages. This allows the borrowers to save money spent on the PMI. Alright, let's learn about reverse mortgages. Reverse mortgages pay money to the borrower as long as the borrower lives in his or her home. These loans are designed for the people aged 62 and above who own their homes and need an inflow of the cash. The loan is against the equity of the loan and is not paid off until the borrower sells or moves out of his home. The payment can be single lump sum, regular monthly payment, or as a credit line accounts that lets the borrower decide when and how much of the available cash is paid. Against this, the lender gets an equivalent amount of equity in the home, which they can claim once the home is liquidated after the borrower does or moves away. All types of conventional and government loans are available with the ERM options. So this is about the reverse mortgages. So we have learnt about what are the different type of mortgages based on the guarantee, based on the interest rates, and based on different special types. So I have touched based only on the basics of these things since it is this particular lecture or the module is learning mortgage basics. We are going to talk about these things in detail in the later sessions. I hope you enjoyed this session. I will see you in the next lecture. Thank you.